goddamn rich. I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Getting fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker.
What's up, Abe Nation? Marcel Kalinovic here, Boss Blunts. It's good to see all you. Thanks for coming out. We're going to have Options 101, hosted by CringleKitten. This video will be focused around the Twitter Spacecall. You are welcome to join the Twitter Spacecall, as well as follow along on YouTube and on the Whiteboard with Kringle and everybody else that is going to be discussing. We're going to be open for questions, but it's going to be pretty intensive and it's going to be beginner-oriented. So we may or may not start talking about the Greeks right away today, but we're going to start talking with basically intro to options. So if you're a new or a beginner options trader or someone just paper trading looking to learn, it's definitely good to get as much experience as you can just paper trading, not actually playing options with real money, because it's extremely dangerous and you could lose every dollar. That being said, this is not financial advice. I'm not a financial advisor. Although I am a business owner, I am not here to give financial advice. I'm just here to provide education and entertainment. Take it for what you will. We're going to be starting here in a few minutes, and as soon as we do, I'll launch the space call. But I appreciate you, Steve, Christian, everybody. It's good to see you. Hey, Pete. Yeah, it's going to be a couple minutes, I believe, here before Twitter starts this thing up. Kringle starts this thing up on Twitter. Make sure you follow him, and he's also got a Discord if you guys want to join. All the links to that are in the description of the page, the YouTube description, excuse me. Links to CringleKitten's Discord are available in the description, as well as his Twitter.
I want my fucking money. I want my fucking money. Gary Gensler, I want my fucking money. Money. I want my fucking money. So goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Getting fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling, give me the fucking money. Get the goddamn money printer out.
Great.
goddamn money printer out. Gary Gensler, I want my fucking money. 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 I want my fucking money. Gary Gensler, I want my fucking money. Money. I want my fucking money. Gary Gensler, I want my fucking money. 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 I want my fucking money. Gary Gensler, I want my fucking money. 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 I want my fucking money.
Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich.
I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling, give me the fucking money. Get the goddamn money printer out.
Great. Bounty letter.
We're gonna be so fucking rich. Get the goddamn money printer out. Gary Gensler, I want my fucking money. 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 I want my fucking money. Gary Gensler, I want my fucking money. Money. I want my fucking money. Gary Gensler, I want my fucking money. 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 I want my fucking money. Gary Gensler, I want my fucking money. 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 I want my fucking money.
Manager, you recognize that losses are part of the game, and thus, by design, you plan to keep losses small when things go against you, right? But of course, when the market is in your favor, all power to you. So, for example, you could learn, let's say that you want to invest through options or stocks, right? You would want to invest on a speculative bio stock, but out of nowhere or suddenly one day, the clinical trial went bust, right? And actually hurts your portfolio and costs you a lot of money because probably you didn't dig deep into that company, or maybe you didn't explore the design of the faulty clinical trial. But that's part of experience, right? So fundamentals are important. Also, stock sentiment is important, and also I'm not teaching you on in this class market. The word market and algo is pretty much synonymous, right? You're trading in the algo, but also against the algo, because the algo on the other side are the market makers, right? We could say that you're trading in a huge casino, right? So there are retails, right? Retails are essentially not, well, let's say retail could be gamblers, right? Your hedge fund could be your professional gamblers. They know the tricks, right? And the brokers or the market makers are essentially the dealers in that casino. But there are ways to, it's really hard to, or nearly impossible to predict the algorithm, right? But they always leave footprints behind for you guys to learn from the technical analysis to see what the algos work. And when it comes to trading, it requires discipline. So it means that you're following rules detailed in your trading plan on each and every trade. So eventually, sometimes your human emotions will get the better of you. So that's part of the experience too. And it will happen. But don't worry, it takes time. But emotions, right? We cannot lose emotions on trades. You can learn how to manage them, right? Every institutional trader does it. So every retail trader does it. There are many Wall Street sayings that have been around for a while simply because they remain true year after year. And there's one that fits perfectly. So when you fail to plan, you plan to fail, right? Always plan to have an entry, always plan to have an exit position, right? So there's that. And trading in experience requires patience, because the world of options is not a quick rich scheme. It requires experience. Maybe you could YOLO and when perhaps you place like a premium of $200 and you get the contract back at, let's say, 2,000 if you're lucky, right? But that's life. But if you YOLO again, it doesn't guarantee that you'll get the same returns that you did on your first trade. So tread carefully. All right, moving to options. I know that was a long introduction, but I just want you to get in the mood how the class gonna be. All right, just give me a second. All right, so depending on your level of experience and risk profile, right? So whenever you're a trader or a longer-term investor, you can trade options on individual stocks. It could be indexes, it could be ETFs. And the best reason to add options to your trading or investing strategies or part of your portfolio is the fact that they allow you to both manage your risk and grow your assets while using even less money per trade rather than owning individual shares. So that's why we're talking about leverage. So when you're purchasing a contract in the options, right? Let's say you buy a call option, well, you get the leverage of 100 shares. That's just an example. So no matter what your option strategy or your time frame are at any time, whenever you hold positions for short or long periods, your goal is essentially the same. You want to have more money at some point in the future than what you have now and increase your wealth using opportunities and provided it by the markets, right? Trading options certainly has, a learning curve. So make sure that you take the time to study the trading techniques that suit you best, right? And the associated risk and rewards. Eventually, after this introduction 101, you'll explore different option strategies. So it could be, let's say, covered calls. It could be iron condors. It could be credit spreads, vertical spreads, long put butterflies, fucking bikinis and martinis, right? There are different strategies out there, but after this class, we'll go over them. And I'm not sure even tonight we're gonna even talk about the Greeks, because this is more like a synopsis. Eventually we'll go over calls and puts, right? But Greeks are important, right? I've seen people on Twitter saying that Greeks do not matter. Yes, they do matter, right? And I've seen people buying weekly options, but weekly options are pretty much useless, and you're just hoping to expect a downward or an upward momentum just to make a quick cash grab. But time are killing options. Everything has to do with time with options, right? Because you buy, let's say, a contract, and the closer that you're getting to expiration date, so essentially that's the date when the contract expires, as day passes on, you lose the some word of your contract per day. So it could be a few cents to a few dollars, depending on your premium. And of course, there are rule of thumbs in the world of options where you would want to buy, let's say 60-day or 45 days ahead before expiration, and you're just hoping that it's gonna be a upward or downward momentum of the stock to sell your contract at a profit. Options trading, as all types of trading, is an adversarial process, right? In other words, whomever or whatever is on the other side of your trade has one goal in your mind, is to take your money. Of course, whether you realize or not, you have the same goal. After all, unlike central banks that create money of thin air, trading profits for one side come at the expense of trading losses for the other side. And most likely on the other side, right, when you're buying contracts or options, you're dealing against market makers, because the market makers, they underwrite roughly 30 to 40% of all contracts in the of all options contracts. So you're dealing with them. And trading algorithms dominate the market, making, trades lightning fast. In the past, stocks were the key to options. However, as of today, because the rising of the AI and technology, algorithms, thanks to algorithms, the options market influences the stock market more of 80% of all trades in the stock and related markets are now made by algos, right? So you're effectively trading against bots. Now, algo day traders is trading at any time, and they don't have your best interest in mind. Moreover, you don't have their best interest in mind either, which means that you should prepare well before trading, right? And if you are really inexperienced into the world of options, small investors start with paper trading. And paper trading involves creating a bogus account under a brokerage service, and lets you play with monopoly money, essentially virtual money that's fake currency, and you'll get to trade the same stocks but it's just a simulation. So let's say that you're willing to trade with AMC or GME or any kind of stocks out there like the SPY, right? Or indexes like the SPY. You get to do a simulation with those stocks with current data and see how it fares for you to test your different strategies on the market. Investing is all about the power of time and the benefits of compounding to build wealth over long periods. The traditional buy and hold strategy for stocks is a perfect example. As for options, you get to trade with leverage. And whenever you want to open a brokerage account, it is very, very likely that a brokerage or your broker will be asking your some information relative to your experience in options, right? And if you have experience into trading them, and what's your capital risk, meaning which is your net income and your passive and whatnot, assets and liabilities. They want to know that. So moving on. You have the world of options, right? Options are contracts. And each contract gives you control of 100 shares. It doesn't mean that you own them. You're just taking 100 shares like a form of collateral away from the market to put into your contract, but you just hold an agreement, right? For example, let's say that you want to purchase a call. A call is essentially a wage that the underlying security would increase in price. Let's say that you would want to buy Apple for let's say the stock of Apple trades at $50, and you think by 3 months time from now, let's say in February, you say that the stock of Apple would be worth $60, right? Hence, you want to buy a strike price of, let's say, $60, right? So Apple shares. Let's say that it's worth $50, right? And by 3 months' time, let's say that the expiration date is somewhere in February, right? So February is your expiration date. And you want to buy a call, right? And your call, your strike price is essentially the price you think that is going to go at or hope to go at. So strike price. Let's say you want to buy a call option for Apple at $60 by February, right? And then, of course, by February, let's say that your call option with the underlying stock of Apple is worth $80. Right? So you just made a profit of $20 of the underlying stock, right? Times 100 shares and so on, you back with a profit, right? But of course, that total profit, when you buy a call options, you pay a premium, is essentially an agreement behind that contract. You buy that contract with a premium. Let's say it could be $5, $10, or whatnot, but you pay a premium towards that seller who is selling you the call. So you're essentially giving $5 or $10 towards the market makers to write a contract with you to say that you want to buy a share, let's say 100 shares of Apple under said agreement. And of course, a call option is essentially the obligation for you to buy shares of Apple, but if it reaches the strike price of $60, well, instead of paying like $8,000, right? Well, you get to buy your shares at $6,000 total, minus the premium, right? And of course, your shares are still worth $8K at market value. So essentially, you would make a small profit of $2K minus the premium. So that's just an example, right? And as for the put options, I like to see it like buying an insurance policy, right? Let's say that you want to let's say insure your house, right? And you're entering an agreement with your insurance policy, and you say that you want to buy a contract. You're paying like each month a premium to make sure that your house is covered. And if your house is worth $0, well, you get paid from that contract. So I like to see it put options like this way, right? Call options is just a wager that the stock would go up. Put options is the wager for the stock to go down. So in layman terms, calls, you buy calls. Let's say, so buying calls, right? It's bullish. Let me rewrite this. Second, you buy calls, it's bullish. If you sell calls, right, you're selling contracts, it's bearish. You buy puts, you're essentially wagering that the stocks would go bearish. And of course, if you sell puts, essentially bullish. Also, when you buy calls or sell calls, you pay a premium. And the other side, when you buy puts and sell puts, well, you receive a premium. So receiving a premium is essentially a dividend, right? Well, not like exactly a dividend, but you get some form of cash payment down the line. And some people, believe it or not, are buying puts and sell puts for a living, and they receive a premium like some form of income. All right, so options are financial instruments that were designed to be priced based on the value of the underlying asset. And at the same time, because of the way algos work, the price in the options market is also a major influence on the price of the underlying asset, right? What's important behind options, right? There's three basic things. There's the underlying stock, as you already know, because options are just like derivatives. And, we have options itself. And under these options, well, you have the algos, or the markets. For me, it's synonymous. And other market participant. So it could be your broker, it could be other retails, and whatnot. So market participants. Or it could be also technical traders or day traders, on however you call them. To fully understand and use options to limit risk or as a standalone trading strategy, you must also have some kind of thorough understanding of the asset on which they're based. You know, this understanding may require a more thorough level of analysis and detail beyond your current routine. Like previous classes, I taught people on how to understanding the company. And understanding the company means that you have to understand what the company is for in the market. What's their balance sheet? So I've taught people on how to dig filings through the SEC websites to find out the balance sheet, what are their assets, what are their liabilities, and whatnot, right? And so on and so forth. So all of that reflects the sentiment of investors into the company, and for traders to make trades into that stock. I like to think of all securities, including options, as risk management tools and trading them in terms of designing an overall portfolio strategy, right? There are three questions I always ask myself before I engage into a trade. Right, let's see. So are you trending with the trend? Because you could have a bullish trend, you could have a bearish trend, or you could have a neutral trend, right? And of course, in order to understand that trend, you can find out trend by analyzing through the TPO charts, like I suggested yesterday. So TPO charts is another measurement tools to know who are the market participants on the other side of the trade. Who are you dealing with? It could be the market makers, it could be the brokers, it could be retail. I mean, it could be hedge funds and whatnot, right? And you could easily find out through TPO charting to exactly find out what's your support level and resistance levels, on top of whatever or not the stock is likely to correct itself to stay within value, right? Within value range. Because I told you guys yesterday that falling prices are for losers, but falling value is what investors should look at, because through TPO charting, you have 70% within that bracket whenever in the intraday, whenever the value of the stock is likely to trade in based on the volume, right? And outside of it, you have the upper trend and downward trend of the TPO charts, and that's where the price could be likely to be rejected upwards or likely to be rejected downwards for reversals. And if the TPO charts overlaps on each other, essentially you'll have a neutral trend where the stock would be consolidating over time within that 70% bracket of volume that is trading with its value, and then eventually is going to find out whenever it's going to go up more or downwards based on retail sentiment, of course. So TPO charts, something else to consider in your analysis. Like I explained, the two kinds of options are calls and puts, right? When you add them to your current investing and through its trading tool strategies, you can participate in both bullish and bearish. So bullish, rising markets, bearish, falling markets. A listed option stock option, like I've said, is a contractual agreement between two parties with standard terms, right? So buying an options, you're essentially buying a specific set of rights. So let's say that you want to buy a call options, you have the right to buy 100 shares of said underlying stock at the desired strike prices if your call options is in the money, right? So we're going to explain about what it means to be in the money, at the money, and out of the money. What you have as rights as an investor whenever you engage into the options market, right? Your rights and obligations are standard and guaranteed by the OCC. So the OCC stands for Options Clearing Corporation. So you never have to worry about who's on the other side of the agreement because what you're trading is against a computer. The price of a call options rises when its underlying stocks goes up, right? But if the move in the stock is too late because it happens too close to the expiration date, the call can expire worthless. Conversely, a put option gains value when its underlying stock moves down in price while the timing issue is the same. So in the world of options, not only you have to worry about whenever or not you're still trading with the trend, right? Either it's bullish, either it's bearish, but you have to worry about time, because as more time passes on, among the Greeks, right? I won't explain the Greeks in detail. It's going to be on the next class, right? But options have to do everything with time. Right? And there's a Greek called theta, or it can be represented by the symbol like this, right? Theta. So theta is, let's say, you have some value on theta. If you visit into some websites and you find out what the theta value of an underlying stock option is, let's say that the theta for Apple. Let's say that Apple has a strike price, not a strike price. Let's say that the cost of Apple is this, right? And the theta value is worth, let's say, 0.05, right? What does that tell you? It tells you that on each passing day, let's say on day one, you would effectively lose on your contract basically 5 cents every day, right? So, in other terms, each passing day, the closer that your expiration date, so expiration and date again is whenever your contract expires, right? How long your contract is valid. So the closer you get your expiration date, the more theta is going to kill the value of your contract, right? Simple as that. And I've seen people on Twitter, again, making the same mistake, buying weekly options before, like 2 days before expiration date, and theta has already killed your the value of your contract already. So theta is a real killer when it comes to options. Like I've said, options have to do everything with time. So I'm not going to go over this again, so I think that's a lesson well learned. But if you want to engage into speculative stock options with literally days before expiration date, you need to accept the risk, essentially. But it's highly not recommended, but that's up to you. A significant part of your skills as an options trader is your ability to select options with expiration dates that allow time for anticipated moves to occur, right? So this may sound too challenging at the moment, but as you learn more, it will make perfect sense, because successful options trading is all about giving yourself time, giving the option time to deliver on your expectations, and not only you'll be able to analyze and adjust, if needed, your trade. And of course, trading options isn't all fun and games. For instance, an important aspect involves paying special attention to how passage of time, like I've said, like theta, affects the value of options over time. So after you get this part of the puzzle locked in, the rest will fall more easily into place, and you'll feel the effects of theta if you paper trade your stocks or your options, let's say. So getting the details of option risk profiles is important and will be useful. Designing and using strategies in trading is even better, because if you start by evaluating the many options that are available for asset protection, but if the market turns on you, you're prepared, spending the time upfront to figure out what options work better than others in different situations is not only a good step in your learning process, but it's also practical, right? And also, like I said, you can always use options to limit your risk. And as you've known, for the past few months, hedge funds, let's say like Citadel advisors, they like to buy calls and they like to buy puts at the same time, because they like to ride the wave on the way up to make money, and they make the money on the way down as well. All right. As you rewire, that is to teach your brain to think slightly differently, you'll get to know the basic principles of options contracts and expanding your knowledge of market analysis and strategy design. So eventually, I'll be teaching you about Fibonacci. It could be RSI, it could be MACD, or it could be market cycle. Eventually, we'll come into that, right? But not tonight, right? We could go to NIAD. So that's a good indicator. I mean, there are many tools at your disposal, or they could be like platforms to give you basically alerts about unusual movement into the underlying stock for you to make a trade, right? So there are many services that provide that, but also these services are often not free. So let's go to the basics. Call, right? A call option gives the owner of the contract the right to buy a specific number of shares of the underlying stock at a specific price, right, by a certain expiration date. And a call option, whenever you sell a call option, right, it gives you the right to, the obligation to sell a specific number of shares of the underlying stock at a specific price, blah, 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 right? But options, again, gives the owner the right to sell a specific number of shares of the underlying stock. And if you're selling a put options, it gives you the obligation to buy a specific number of shares. In order to maximize your use of options for both risk management and trading profits, make sure that you understand some underlying concepts, right? So call and put. You need to learn what's the strike price. So call and put, I think that people understand what the call and put is. A strike price, essentially the target, the price target, whenever the underlying stock would end at your contract by expiration date. Expiration date is another term. It's essentially the time allocated while your contract is valid too. What else is there? There's a premium. So, like I said, it's like a small fee that you pay whenever you want to buy a call or buy a puts. But if you sell a call, if you sell a put, well, no. If you, my bad. Like again, always draw charts to make sure that I'm not giving the false information. So if you buy calls, right, and sell calls, right, essentially you pay a premium for it. Even I do mistakes, so I apologize. Yeah, that's right. Even I do mistakes, but if you buy call and sell calls, you pay a premium. And if you buy puts and sell puts, well, you receive a premium. Even I don't master options trading, so sometimes it's a repeat of information, and sometimes information gets lost. Perhaps I'm mistaken, so please correct me on that if I'm mistaken in any parts, right? We all do mistakes, right? We're all human. And sometimes a cat doesn't drink coffee, so.
To clarify, the collection of premiums is when you sell the options contract. So when you sell the put or you sell the call, that's when you're collecting the premium.
Thank you. That's where I'm mistaken, so yeah. Let me correct that misinformation so people can take notes. Sometimes it's not cooperating with me. I can see the eraser. There you go. So let's recap. My bad. So you buy a call, you buy a put, you pay your premium. And then if you sell a call, if you sell a put, you receive a premium.
Hey, Kringle, can you hear me, brother?
There you go. It makes much sense now. I think that there's a request for making the pen a bit more darker. So let's test. Now it's better. So now people see.
Yeah, that's perfect.
All right. So moving on. So trades have two sides. So your side and the other side, the counterparty, which is the algo or the market maker, right? When you buy or sell an options, or someone or something like an algo does the opposite on the other side of the trade. So their actions have as much or more effect on the markets and your chances of your chances of success as your own side of the trade. So let's go into different types of securities, right? So options are forms of derivatives, a type of security that derives its value from an underlying security, right? And there are other derivatives, right? Let's say you could deal with the commodities and future contracts. Like options, commodity and future contracts are an agreement between two parties. The seller or an option is obligated to buy or sell stock if the option buyer exercises the option, right? That's because commodities and future contracts set the price for a predetermined quantity of a physical item to be delivered to a particular location by expiration date, right? Indexes. You can buy options or dealing options with them, with indexes, like let's say the VIX, right? The VIX, you can buy options on the VIX. Also, you can trade ETFs, right? ETFs are mutual funds that trade like stocks on an exchange. ETFs aren't derivatives, but it could be considered almost like derivatives because they don't always hold the same exact securities of the index that they track, right? Stocks and bonds, different. Stock ownership gives you part of the company, whereas bond ownership makes you a debt holder, right? So essentially, like I've explained, and many times over, when you're dealing with a stock with short inventory on the side of market makers, right? Well, the market makers, they have the right to make it short a stock to retail as more demand is exploding and they don't have the inventory to give you a real share. So essentially, you're buying like a bond, right? But it's like acting like a real stock. So essentially, you're buying a debt coming from the market makers, and eventually the market makers would have to pay back their debt obligations to you guys, but you don't own a real share. There's another type of security or financial instrument that is called a swap. So a swap is like an insurance contract where terms are privately agreed upon by the participants. So they can be thought as of non-exchange traded options, and they can be used to bet on the direction of just about anything that the two parties agree upon. By design, swaps are really, really sophisticated securities that aren't available to individual investors unless that you're coming from a very coming from an institutional background. Because of the financial requirements and the specific agreements required to be signed require higher capital. When you own shares in a leverage ETF, right? Make sure to check the prospectus to see whether your ETF is a swap containing vehicle, right? So when swaps get out of control or malfunction, usually due to poor design or insufficient collateralization where the counterparty can meet its obligation, the markets and the portfolio can effectively suffer. So that's what happened in 2008, as of lots of big money players bet, correctly, that subprime mortgage holders wouldn't be able to make their monthly mortgage payments, and swaps, credit the default swap, that's what they were called in 2008. Well, it's like buying an insurance policy against a falling housing market. All right, let's review again. I always insist on reviews, but reviews are always good. So, options, right? Options. You deal with the type of security. So it can be indexes, it could be stock, it could be, I don't know. Let's say stocks, for example. It's much more easier. Type of security. Then you have the strike price. What's important? The price of the underlying security. That's what you follow, right? But in the institutions, we don't follow the price. Prices are for the losers. So let me correct that. Select, delete. I'd rather say value, because we don't chase price, we chase value. Also, what's important is the characteristics of past trading patterns. So what is likely to replicate in the future, but it's not guaranteed to happen. So we'll go over that. There are different trading strategies surrounding different indicators, and NIAD, Bollinger Bands, RSI, MACDs. So you're gonna learn that in future, not tonight. And the time remaining. So the time remaining until expiration. We'll keep repeating that so it's wired into your brain. Right? And of course, what's important are the Greeks. No one skips the Greeks. Right? And also, if your stock is found into an index, so the index, it could be the SP 500, it could be the Dow, it could be the NASDAQ. So the index matters. So let's say that, for example, per miracle, AMC or GME could be part of the SP 500. So the price of the index could affect the options, right? So premium, you already know. That's premium is essentially what you're paying down. All right. So options deliverable are like the number of shares or the amount of money in case of index options, and the name of the underlying security that you can call away or put to someone. There's a market quote, right? There's a market quote. Market quote is the most current price of an option that is being bid on by buyers and offered by sellers of options, right? So these are the basics of what you should learn as terms of options terminology, right? So options rights don't last forever, like I've said, so keep track of how much time you have left in a position before it expires. Again, theta is a killer to options, right? So if you buy weekly options, days literally before expiration date, your contract is nearly worthless. But if you buy like months before or weeks before expiration date, you have much more leeway and more work to your contract. But of course, the more you buy farther away from expiration date, the more it is expensive to buy into your contract. So be mindful of that. But of course, if you're closer to expiration date, considering that contracts are nearly worthless, they are not worth as much. So as an example, people in the last run up in June for the AMC squeeze, the price ended up at the peak at $72 or $77, right? At the peak of the last leg run. Literally, the market makers, they open up a position, they underwrite call options a strike price of $145, right? But they're the ones behind the algos. They're the ones behind basically the stock, right? You're dealing against a dealer. And the closer you are to expiration date, your contract is already worthless, near worthless. But again, you're going to lose your premium. You're effectively paying a premium to market makers, and unfortunately, you have lost it. So that's one of the prime examples. So not only you have to deal with against time, you have to deal against the dealer, because like I said, options could be viewed as a casino, and the dealers are the market makers or the algos. There's another term I forgot, is the open interest. So the A lot of people have mistaken open interest as the number of shares. No, it's not the number of shares. It's the amount of contracts or mutual agreements or options involve a specific strike price. So let's say let's say that Apple shares, let's say that the Apple stock have options, right? You have $50. A $50 strike price, you could have, like, let's say 5,000 open interest. So it means 5,000 contracts, right? And then at $60, you could have 2,000 contracts, right? Same thing. Another thing, when you move into Yahoo Finance or whatnot, is that often, let's say that you have an Apple. Like I said, I always use Apple. Let's say that the symbols of a contract is often written like this. When you say, like, it's APPL, and the next thing is literally the date of expiration, right? So it's year 2022 for the month of May, 05 for the 5th of May, let's say, right? And of course, you buy a call or a put. So it's a call here, and the strike price would be at $150. So it would be like this. So that's what you see on Yahoo Finance. So that's the kind of contract with the sign. So if you have a problem with your broker, well, you just show this number, and they'll give you the exact information about that trade and what happened about that trade. So if you have any inquiries, you use this number and you contact your broker, and you'll find out exactly how your trade was executed. So expiration dates are important because as time passes on and expiration nears, again, options lose time value, right? And thus the value of the option drops at a faster rate at the expiration date approaches. So it's not exponential, but you're gonna lose a hell lot more as each day passes on. To maximize your odds of success, so train yourself to have a good idea about what you'll do with any open option positions well before it expires. So if you hold the option to expiration and it's in the money, there are different choices that you can make. So take advantage of your rights as a contract holder by exercising. So exercising requires contacting your broker and submitting the instructions to get your shares, right? So if you buy a call options, you get to exercise your shares at a specific strike price. Or another option would be to close out the option prior to the automatic exercise and take your profits. So um, your contract has value. So even before expiration date, you can forego your rights as a contract holder and sell your contract on the market, right? So you get the contract value, current value, at a profit minus the premium that you have paid. Or you could let the option expire worthless if it isn't in the money. There's a thumb rule within Wall Street. You can choose to not follow it, but that's really up to you, right? They say that they never hold an option that they're planning to sell when their expiration is less than 30 days, because the time value will decay rapidly and the options price would just fall. And there are key details about expiration date. So first one is to know your last trading day, because at some point your value will of your contract will peak depending on the stock performance, because, and of course theta on the other side will be hurting your contract value, right? So know your last trading day, and that's part of your exit strategy, right? My rule of thumb for my personal portfolio, right? I can give myself a leeway of 20% risk, right? But you can opt for 5%, 10%, 50%, or you could YOLO, right? That's really up to you. So there is no excuse for not knowing about your last trading day, because if you fail to know it, you could lose your money. And the best way to address this is to write down on your trading record and review it as the trade progresses, right? So know that whether the expiration is in the morning or the afternoon, right? So the last trading day for morning settlement is the day before expiration, right? And afternoon expiration settlement is on the same day as expiration. And your broker will alert you on any option you own that is about to expire, right? And if you have any doubts, contact your broker to make sure that when is the settlement for your option. And it's always or almost always better to close out an into the money position prior to automatic exercise upon expiration. Like again, when you buy a call option, right, you can forego your rights as a contract holder to sell your contract for a profit. So you don't have to exercise your rights as a contract holder to basically get your shares that you want, right? You can get a profit from your contract, so you don't have to exercise. So again, when you buy a call option, you're buying the right, but not the obligation to buy a specific amount of stocks at a certain price at any time, right? Before expiration date. So you can sell your contract before expiration date. When you buy a put option, you're buying the right, but not the obligation to sell a specific amount of stock at a specific price at any time, right? When you buy a contract, you can sell it back towards the market. All right, just give me a second. I'm going to get the cup of water.
One thing to think about is that theta is not, it doesn't tick daily, right? So if your option's out of the money and you're, within 30 days of it expiring, it's going to be a lot harder to see a larger profit, a larger upside, because if it's out of the money and the stock is moving against you, you're going to eat theta right there. It's going to tick away right there. It's not going to be a daily thing where you log in and it's like, oh, my option is X amount cheaper today or less valuable. Those numbers are going to decay instantly when the stock moves against you when you're inside that 30-day window.
All right, so let's move on to selling an option that you don't own, right? It could happen. So when you sell a call option as an opening transactions, you're obligated to sell a stock at the strike price at any time until the option expires. So during that period, if a call option holder decides to exercise their rights, you may be forced or you may have to meet your obligation. So when this happens, it's called being assigned to options, and your broker will contact you to inform you about it. So when you're assigned a call option contract, there are two possibilities. So if you own shares of the underlying stocks, you must sell the shares and close the stock position. If you don't own the shares of the underlying stock and you don't sell the assigned shares, you effectively create a short position in your account. The most important part is the understanding of the risk in the trade. So if you own the shares, when you sell a call option, it's known as a covered transaction because the shares cover the short call position, right? But if you don't own the shares when you sell the call, it's called the naked call, right? So what makes this strategy most dangerous is that it has the same risk as the stock short positions. In other words, your risk of loss is unlimited for a naked call, right? So a naked call so it happens when you don't own shares. When you sell. So when you sell a put option as an opening transaction, you're obligated to buy a specific amount of stock at a predetermined strike price at any point until the option expires. So you own this obligation from the time as you open the transaction until the expiration date, and you're required to satisfy the obligation if a put option holder decides to exercise their right. So getting assigned on a short put usually happens when the underlying stock has declined.
That means margin call.
Hey, Kringle. So, yeah. So selling puts is a tricky transaction, but so when you take on the obligation associated with this transaction, you're no longer making active decision with the underlying stock. And the risks associated with the short open transactions are different depending on whether you have covered or a naked transaction, right? All right, so moving on. So you have the basics. So you know what's a naked call. You could apply with the naked put as well. You know what's the ticker for an option contract. So whenever you have a problem, you want to know how your shares are executed through that contract. Well, of course, you know the basics. So I'm not going over that. So moving on to more spicy things. They are more than 10. There are more than 10 option exchanges active in the United States, right? There's the BATS, right? There's the NASDAQ options market, so we call it NOM. There's the Chicago Board Options Exchange, so we call it CBO. There's New York Stock Exchange, right? Operating under ARCA. And another one could be International Securities Exchange. So these are kind of different exchanges happening for options. Those are the main ones. And the cop behind the options world is the OCC. So like the stocks, the cop is the DTCC, and the options world is the OCC. So there's another information. So your broker may or may not give you a choice of where you want to trade. In fact, your order will probably flow to the highest bidder, as in the case of brokers like Interactive Brokers, Robinhood, or whatnot, and others who route their trade to the high frequency market maker, which gives them the best rebate. And unfortunately, selling your trade orders to high frequency traders and other market makers is a very big revenue generators for brokers through the payment for order flows, obviously. But that's part of how Wall Street operates. For the longer term, just get used to it and factor it into your trading cost. But of course, we're all against that. And as a result of the regulation, national market system, high frequency trading companies have become a significant group in the making markets. So they use computers and algorithm programs to make millions of trades per milliseconds. And your orders and mine basically get caught in this algo fuckery, right? The reality is that it often costs traders a penny or two per trade, which certainly can add up over a year's trading. So although it may cost traders a few bucks over time, using this type of strategy. Yeah. The order that is routed towards the exchange is where the algo with the fastest computer or programming fits what you're trying to do into its current trading objective and executes the order not to your advantage, but to the HFT advantage. So basically, the algo is trading against you initially, right? Meaning the initial trade isn't likely to be in your favor. So don't let the algo scare you. That's how the market structure is built. But over time, if you plan your trades right, you can still be successful and make money out of it. And if your order is routed to an exchange with a less favorable market quote, that exchange can either improve its price or send it to the exchange with the best quote, because the exchanges are all linked electronically. If and when your order is executed, a report is sent back to your broker with the trade details. So like I've said, you could just send the ticker over here about your broker, and they'll tell you exactly how the trade was executed and cleared. Orders that improve the best market code are posted quickly on the exchange where it was routed. So the order is reflected across all exchanges as the best bid when buying or the best offer when selling. So it remains there until it's executed or a better bid or offer replaces it. And of course, if you're experiencing irregular delays in order execution, you need to consider your choice of orders, the liquidity of options you're choosing, and perhaps even how your connection towards the exchange is doing. All right, so let's move into different market participant. So you're branching out a bit from options, so you have to understand what are the market participants really. Okay, so you have the brokers, right? So brokers, before you even create an account with options, right? The broker may not have the best interest may not have your best interest in mind, but you're still their customer, right? So in a sense, they have a fiduciary responsibility to protect you, but also it needs to protect itself because of the unlimited risk option positions, such as, like I've explained, short naked calls that could expose you both parties to very high losses, right? So, brokers must follow minimum rules and regulations, but it can also operate under ones that are stricter. So, communicate with your broker to understand key trading items such as margins and maintenance rules, right? So, they are specific, different. Yeah, there are different rules between different brokers as terms of margin and maintenance rules, right? And the other participants would be the market makers, MM for short. Market makers who are almost exclusively algorithms, so I call it markets, or are responsible for providing a market for your orders, right? So meaning they're required to take the other side of your trade at the quota level. Because they're algos, they have access to all the data before you do and can find millions of ways to make your trade happen as long as it's up to their advantage. Never consider the market maker would work at your advantage. No, it's always the advantage at their side. Although you may not always agree with their quotes because of the way the markets are structured, because the machines have replaced humans essentially. Algos are crucial to the exchanges by providing liquidity and assuming risk, as long it suits to their program, as long it fits to their pockets, right? They also keep the markets orderly, so your orders are handled by price and time priority. Even when they are buying frenzies or selling panics, on the markets. Although this isn't guaranteed because sometimes the algos just stop trading based on their programming. But it happens during periods when the algos can figure out which way to make money based on the order flow in the markets. And sometimes there are confusion due to faulty programming. So it could be an unexpected news event in the world, or it could be, let's say, a glitch, right? It happens. Not too often, but it happens. And of course, whenever that mistake happens within the algos, the net effect is that liquidity in the market can dry up. And this is what causes flash crashes, right? And periods that sometimes last a few seconds or minutes where prices fall rapidly. And as you know, markets are really, really fragile as of now. So there are a lot of liquidity being raised through the crypto market, through various pump and dumps, and we have the penny stocks as well. Same thing, same behavior, right? In order for market makers to generate market interest through these, in quotes, pumps, right? And eventually they use the sell-offs to create the liquidity they needed from their bid and ask spread. So that's how they make their money. When trading options, you know, you can find the most active options for each exchange. Uh, Although the algos are, just assume that the algos are watching every move you and every trader out there makes and acting accordingly for their own account. When you enter into financial contract, right? Um, you may be curious as to know who is the person on the other side of the agreement. But what you're really dealing against is a bot, right? An algo. And who's protecting your options rights is essentially the options clearing corporation. So it's the clearing firm that guarantees option sellers that would meet their obligation. So that means whenever you buy an option contract on an exchange, you don't have to seek out the seller when it's time to exit your position. So whenever the other seller isn't able to fulfill the commitment is essentially the OCC as a form of guarantee that you will get paid at the other side of the trade. So just think of the OCC as like the trading floor cop who keeps all tabs on the algos, right? There are also market conditions, right? So we're branching out a bit away from options, but it's just general information that works like stocks, it works for bonds, it works for any financial instruments out there, right? Market conditions. You may have halts, volatility halts, or circuit breakers, however you want to call them. So good thing to know, if you hold options for a halted stock, that means that the options are halted. So if the stock doesn't move, well, it means that the option as well. Right? So if you hold options, the options are also halted, so you still have the ability to exercise your contract's rights when this occurs before expiration, right? There are also fast trading conditions for a security. So when this happens, you can expect to see quotes that are changing quickly, and you may experience significant delays in order execution and reporting. So unless you must exit a position for risk reason, I strongly need to put you into caution into using market orders for options in very, very fast markets, right? So if you're dealing with a lot of volatility, in fast markets, right? Right? You will have delays. In order execution, and reporting. And sometimes you won't have the best execution because of the delays being piled in, because of the lot of orders could show up as form of open interest, and it just happens, right? Also, a definition, right, of best execution. Execution quality is a general term used to describe a broker's ability to provide trade completions at the current market for the security. So that means when you place an order to buy an option with an asking quote of, let's say, $2, right? Your order may be filled in a timely manner at $2, or even better, depending on liquidity and market conditions, right? And execution quality reports use the NNBO. So it stands for a national best bid or offer, right? So execution quality reports use the NNBO for all exchanges trading the security, right? So options exchanges are required to send a daily report to your broker whenever a trade is executed at the price other than the NNBO, referred to as trade truth, right? If you aren't satisfied with the execution you receive on a specific order, or if you have an order that was marketable and still open, contact your broker immediately, and perhaps your broker may be able to give you the difference. If not, that rarely happens. I believe it was back in 2000 or 2005, I'm not sure. The SEC has adopted some rules requiring market centers or market makers, including brokerage firms, to report on the execution quality and handling of its brokerage operations retail order flow from you and me, right? And there are two rules. There's rule SEC 11 AC 15, and the other one is the SEC 11 AC 16, right? The first one it just provides a monthly report on a variety of speed and execution measurements for all orders covered by that rule, which includes retail market orders and limit orders that are received during regular trading hours. And the other one, the second rule, is essentially like a quality reporting, identifying where the brokerage firm sent its covered order flow along many material relationships the firm has with their market venue. So it could be any payment it receives from an exchange for its order, and that includes order flow or payment for order flow. So that's just a fun fact, right? All right, moving on. Moving back to options. So we're talking about option risk. Right, option risk. As you know, time is against you. So I'm not going to explain that all again. But options have some sort of double edge sword of leverage. So either it can work at your favor or highly against your favor. So that's what it means. As you know, options don't cost as much like the underlying stock, which means that they experience large percentage of price moves in reaction to a very small price moves of the underlying stock. This can result in very huge profits when the stock moves in the desired direction by a small amount. But it can also result in a 100% loss if the stock moves in the wrong direction by a small amount. So if you're really out of the money, everything expires basically worthless. So if you're in the money, well, good for you, because you have the leverage, you have the bigger rewards instead of owning the real shares. All right, you will need to understand liquidity, right? Liquidity. This is sometimes really often used by market makers. So low liquidity, right? When a stock is low liquidity, let's say low liquid, are more expensive and can be riskier because the option price may move rapidly, especially to the downside. As of high liquidity, well, it's the opposite side. It's less expensive. And of course, time is important. So the more time you're purchasing on your contract, the greater the cost of the option. It makes sense, right? So people tend to buy contracts closer to the expiration date. Maybe it's due to cost, but as time passes on, the contract will lose value. And although many options contracts are actively traded with high open interest, the sheer number of contracts available to trade means there will be also those who have limited daily volume and open interest levels. So this results in a wider spread, which translates to higher cost for you and higher risk, especially on the downside. The spread is often used by market makers. So the spread is the difference between the market bid and the ask, right? So when liquidity is low, the spread widens. And slippage is the trading term associated with the money lost due to the spread. So the best way to think about this cost is if you were to buy on the ask and then immediately turn around and sell the option on the bid. So you'd have a loss called slippage. And liquidity saves you money. So lean towards higher open interest contracts. So, of course, when we're talking about alleged manipulated stocks, right? When we're dealing with very, very ridiculous open interest, right? Just know that the ones purchasing these high number of open interests are institutions, mostly institutions, not working for retail essentially, but institutions that as a form of hedges. Right? And they may not act as your best interest, but fun fact is that if you're leaning towards higher open interest contracts with higher daily trading volumes when trading options, these liquid contracts can be easily entered. Let's see, the barrier of entrance is easier because there's always a market, or there's always a buyer and a seller because of the open interest, because there's more interest into the open interest that is available into that underlying strike price.
Something to add on the slippage topic is if you're concerned about a low open interest, you might want to look into setting a limit order so you can minimize the amount of money you'll lose initially opening up the contract. The problem with that is you run the risk of not getting filled. So if you're confident in the play, maybe just slap the bid or the ask, but limit orders will help counter some of the slippage.
I know it's everything. This is not related to options, but it's going to make sense once you're going to enter the options world. So it's just going to prepare you. So we're going to move on to. I didn't expect to reach there, but we're going to talk about the Greeks. All right, the Greeks. So I think that I guess you guys are much more visual. So there are 5 Greeks, right? There's delta, there's gamma, there's theta, there's Vega, and there's rho. I forgot what the sign is. I don't know my my Greek alphabets, but that's fine. All right, so delta is one of the most important besides theta, because theta, like I said, options have to do everything with time, right? So let's put it into exercise so you will understand the purpose of delta. Like again, I'm going to use, so let's say we use we're going to use Apple, right, again. So let's say that Apple is worth $50, right? And right now, the premium you would have to pay, let's say it's going to be, the price of the premium would be $3. That's the price, right? Of course, times 100 for 100 shares as terms of leverage, right? And there are different values behind these Greeks, right? So let's say that there are, let's say theta, let's say have a value of 0.3, Vega has a value of 0.07, rho, I'm not going to cover that today because they are, the 4 main ones are delta, gamma, theta, and Vega, right? Delta, let's say 0.5, right? And gamma would be, I don't know, let's say this, right? So essentially, let's say that the stock goes up at $51. 0. Essentially, at each dollar increments, right, that the stock goes up, it affects the Greeks. So at every dollar increment, so if the price as of today rises from $50 to $51, the strike price would, so the math is $3.35. So that's on day one, right? That's on day one, right? And of course, you apply it to theta. Theta is the time decay. So minus, so your contract, well, the premium or the worth of your contract for a single share is this, right? And then you're moving to day 2. Come on. My board has crashed. Just give me a moment. Why does it have to be the Greeks when the board has a crash? All right, just give me a second to reset. It's like set to connecting. Maybe there are too many people actually watching the stream, that's why it crashed. Just give me a second. I'm gonna try to switch to different browsers, see if that works. No, I'm not being able to connect. So yeah, that's unfortunate. But all right, let's do this. There's a very educational video about the Greeks, so you will easily understand how the Greeks work. Let's say add tweet. There you go, and perhaps I will be able to share it on top. I'm really sorry for that. Share. So that's the link. So this is really well done by TD American Trade. And it gives you the influence of the Greeks for the options, right? So essentially, delta, we have explained delta, gamma, theta, and vega, right? Oh, there you go. I'm connected. Yay. So again, let's move down. All right, so that's on day 1, right? Day 1. So you add the Greeks. Gotta be kidding. So you add the Greeks on day 1. So the contract. So you do plus 35 minus the time decay, right? So it's worth at $3.32 on day 1, right? So that's what your contract is worth. And then on day 2, let's say that the stock is worth $52, so it has moved up another $1, right? So gamma adds to the value of delta, so it becomes 37, right? So that's the change to delta, right? And then same thing. So you do $3.32 plus the change in delta, which is 0.37, minus the time decay, right? And of course, Vega, it plays with volatility. So every time the implied volatility or the volatility moves by 1%, then of course the worth of your contract adds up, so it's plus by 1% of implied volatility, right? So that's that. So every time the stock moves up, so technically the contract of your the call contract that you're paying, every time the Apple share value moves up, the contract, well, essentially is much more expensive. But of course, as day passes on, again, theta hurts the stock. So theta works against the other Greeks, right? So there's that. So there's an educational video done by TD American Trade. You can just click above, and TD American Trade would basically give you like very, very good information about the Greeks. So delta represents the expected change in the options value for each $1 change in the price of the underlying stock. Gamma represents the expected change in delta for each $1 change in the price of underlying stock. So, like I said, on day one doesn't on day one gamma hasn't affected the delta yet, but on day two it just adds up to this value because it has increased another dollar, so 0.037, right? And theta just minus because it works against the other Greeks. And Vega is essentially the expected change in the options value due to changes in volatility expectations for the underlying stock, right? And rho, well, I don't use rho, so this rho just estimates changes in the option value due to changes in the risk-free interest rate, right? So option price changes attributable to interest rates. So this last measure receives less coverage because it doesn't really concern us. So Greeks are easy to understand when you put it to practice. Use the Greeks initially when you paper trade. So paper trade is essentially creating an account under your brokerage service to play with monopoly money. So essentially you're running a simulation of stock market to trade. So it's a bogus account with monopoly money, right? So, and of course, when you move into real trades, live trades, well, you use real capital, and that's where the risk comes in because it's real money. But always practice with paper trades whenever you can with the Greeks. I don't know why the pen is.
One thing I'd like to add to that is when the implied volatility does rise, that will increase the price of the option. And if you are in it before that implied volatility increases, great. If you are not and you buy in after, you could deal with something called an IV crush. And that's when your option, even though the stock doesn't necessarily go up or down depending on if you have a call or put, but your option can decrease in value simply because the implied volatility is dropping because the stock has stopped moving so far one way or the other. So you're going to see a drop in the value of your options contract because the IV is getting crushed.
All right, let's move on to implied volatility. So IV, right? So implied volatility is one component of an options price and is related to the time remaining until expiration. So on a given day, based on IV, There's what's involved in IV, right? What's affecting IV is the current price of the stock, the nature of past movement for the stock, the type and strike price for a particular option, and the number of days until that option expires. So what you don't know, of course, is what the stock is going to do between now and expiration. So no one knows this, right? So, however, what everyone in the market does know, including you, are essentially the four things that I just mentioned. So current price for a given stock, nature, past movement, type and strike price, and the number of days until that option expires. Because nobody knows how the stock would perform as of tomorrow, but you can always measure the likelihoods of where the stock is going based on the demand, and if you figure out who are the market participants, although it's not guaranteed, right? And implied volatility is based on historical volatility, so also referred as statistical volatility. It's a measure of past movement in the stock, right? Um, all right, so moving on to risk. Moving back to risk. So moving back to risk. So risk, the possibility that you lose is part of life, right? And options and stock trading have more than their share of it, especially in a world where central banks are printing money on an accelerated basis, and where options trading volume has overtaken the volume in individual stock trading. So moreover, measure risk is not just by the possibility that you may lose, but also by the amount of the potential loss, which is why option strategies, when used correctly, are better risk management tools than other investments. Successful and professional and experienced traders at any level decide whenever they're going to exit the positions before they enter a trade through either placing a stop loss or setting a price target where they'll either take partial profits or exit the position. So if the trade moves in the right direction, of course. And though that remains an excellent idea and practice, how the strategy and process of putting together a sound trading plan are carried out is even more important. So always have an exit strategy, right? When you use an automated order designed to get you out of position, or choose to execute the exit manually, stocks may gap down, right? Even worse, if you're planning a manual exit, the hit to your position may be even greater. So in fact, price surprises either at the open, the close, or during the trading day are much more common, because they're often triggered by the keywords of new releases and other techniques used by algorithms. And the bottom line is that the maximum risk for a stock trade is your entire initial investment. So if you use margin, you can lose more than what you have started with. That means in order to avoid catastrophic losses, investors need to realize or recognize the fact that you could also lose large amounts of money, and you need to be aware of how much a situation can develop in order to reduce the odds of it happening to you. Any pro will tell you, so if you want to hang around as a trader, you'll spend a lot of time mapping out your potential risk. Thus, appreciating your risk should come before worrying about your potential reward. risk comes into varieties, so the potential for losses and lack of gains. Right. Sipping some more cup of water. All right. So let's move on to graphs, right? In the traditional ways on going long for a stock, right? Let's see. So when you're going long on a stock, sometimes this is 0. And that's the price of the stock. And that's the profit on loss, right? So that's when you're dealing with real shares. So the profit margins are look like this, right? So there's unlimited reward. And the entry price here, that's the break-even price. So that's your the barrier of entry, right? Break even, so the entry price. I'm sure that you have seen this graph somewhere else down the line. So that's going long. So that's the traditional way to trade long shares. And when you're short shares of stock, right? So when you're short, or let's go bear, all right? I think it's better to say bear. Bear shares of stock. Well, the graph, so same things as the stock price, so that's your profit loss. The price is 0 here. And when you're short shares of stock, the price would go like this. And that's unlimited risk. That's your entry point. Right. Right. When we're moving into options, right? For options, it's a bit different. Especially whenever you buy a call or you buy a put. And initially, for a long call options, what the graph looks is that you're paying a premium, so you're losing a premium, right? So the graph looks like this. Because you're losing, you're already negative because you paid for a premium, right? And same thing for a put. So if you're going long put, the graph looks like this. Same thing, price of underlying, profit and loss with 0 here. So initially, it looks like this. You're taking a loss because you paid a premium here. And the put, well, won't be here. For in terms of the price loss. Okay, moving on. So let's say that you would assess the markets or the algo. Let's explore the algo bias, right? I'd like to imagine that the market's main job is to make investors look foolish as often as possible. But now, the market has been replaced by algo, or they are pretty much synonymous. So right now, it's the algo's job to make everyone look foolish, right? In other words, every tick of every trading day of the stock or even in the options market has a mind of its own because of the algo trading programs and the instructions fed into the machine. And don't ever forget that, especially when you think you figured out the next move, because the algos have already figured it out before you do. At the same time, while the algos may be unpredictable, they often leave their footprints pretty much everywhere. So if you know what to look for, you can use it to your advantage to make better trading decisions. For example, you might expect a decline when weak economic numbers are released, only to be surprised by the rally that follows. Or you're certain that you'll see a boring day after a widely held company releases a profitable earnings report. And then you're just surprised with the ensuing decline that's attributed to this news. Although you can never be 100% certain about any market event or response, but you can always be better prepared by following market breadths and options trading data as you become more familiar in using these types of indicators. You're more likely to get a sense of the market's move before these seemingly crazy swings as they alert you to pending changes. And even in the presence of algos, all market advances and declines aren't the same. Advances can occur at a moderate pace with a lot of sectors rising together, or in a frenzied manner with some particular stocks and sectors that could be strongly outperforming others, right? Uh, for that reason, trying to predict what a market will do at any one time is just a waste of time. Instead, you just want to gear your analysis towards assessing the odds of sustainable trend being established and the likelihood of the direction of a trend continuing for an expected period of time. Like I've said, stocks is always based on supply. And we're taking the example of meme stocks like let's say GME or AMC, right? The inventory is short on the market makers. That means that in the circulating float, there are no more real shares available. So what they do is that the market makers, they give you like a security, like a bond, but it's a share. It's a fake share, synthetic shares, or naked shorting per se. right? They are shorting to retail as demand rises with retail and they want to buy more. Well, the market maker, the algos, right, they don't have a choice to short more because they have to give you an underlying security that may be empty, but that's just debt that they have to buy back. And of course, like I've said, the market makers or hedge funds, well, market makers, let's forget about the hedge funds. So the market makers, they can create funding accounts at any time, and they are just like credit cards, and they don't care about settlement dates, right? But eventually, the computers, they have some, they are programmed to follow some risk profiles that they are allowed to have themselves in order to manage their own portfolios, and that is called internalizations or internalizers, right? They are dealing. So they are dealing in respect of a bid-ask spread to make profit out of liquidity. And given the circumstances, right, the supply and demand, then there might be imbalances as demand may be ridiculous, so the price may not be the movement of the underlying price may not be reflective as the semblance of market demand, because as more demand rises over the amount of outstanding shares, well, if their inventory is short, well, they don't have a choice to short. You know, algos. Algos. I'm not sure why the width of the pen always changes. Okay, that's weird. Okay, so the algo footprint, right? Like I've said, the algo, it's impossible to predict the algo, right? Because they are dealing with themselves, with their own portfolio, on top of responding to market sentiment. But they always leave footprints behind, and that footprint is called often the tape. The tape is essentially recording every trade that has happened on the market. And the footprint, there are some indicators, right? One of the indicators is called the market breadth. Right? So the market breadth is the most important indicator and one of the most reliable, useful footprint in the age of algos, regardless of any tricks, so-called spoofing, right? But in the world of in the institutional world, we don't refer as spoofing. Spoofing is a retail term. In the institutional world, we call flushing. So it's a practice of posting orders on the stocks in order to lure traders into making a transaction and then canceling them, right? So algos cannot fake how many stocks are advancing or declining at any time in the market, but it can place orders to create FOMO sentiment on the rise and on the fall of stocks. So usually they place orders to generate market demand and to fool people into placing their orders, and the algos have the ability to retract bids and ask, essentially leaving the other market participants to bag hold essentially the investment. It happens often on a daily basis, but you're dealing against a bot, you're dealing against the dealer, all right? Or maybe in the options where you're dealing against the dealer in a casino, same thing. The breadth the market breadth is essentially the heartbeat and gives you an in-depth look at the nature of the components of market rises and declines. So when you keep track of the number of advancing versus declining stocks for a specific index, you can gauge the health of the move for the index. So during rising markets, you want to see the gains spread out among the largest varieties of companies possible. On declines, you look for signs that there's so much participants that the bear exhausts itself. So it happens. And basics again. So we're branching a bit away from the options, but you need to understand the underlying market, right?
I think it's time to blow this thing.
In a well-functioning bull market, most sectors and stocks should rise with the major.
All right, Ape Nation, it has been quite a couple of hours here. We've got a lot of information covered so far, and we'll ask Kringle to go over the rest of it a little bit later on. This is going to be a multi-part thing because there's no way he's going to get through the rest of this tonight. So I hope you all have a great evening. It's Saturday night. Enjoy your weekend. Learn some more about options. Hey, Parker, say goodbye. Say it louder. Say bye, Ape Nation. Louder.
Bye, Nancy.
Okay, bye, Nancy.